There is a strict dividing line in macroeconomic theory over one contested question: what happens to the private economy when a government runs a deficit? The standard orthodox consensus dictates that a government is financially constrained. To spend money, it must first obtain that money by either taxing its citizens or borrowing from the private sector. Nobel laureate Paul Krugman serves as a high-profile defender of this mainstream view, maintaining that government deficits inevitably carry a heavy cost. This diagram illustrates the orthodox model, known as crowding out. It assumes there is a fixed, limited pool of private savings available. When a government runs a deficit, it absorbs those funds to finance itself, leaving less money for private investment and driving up interest rates for everyone else. The entire mechanical model relies on one specific operational assumption: that a sovereign national treasury functions exactly like a constrained household checkbook. Income must equal expenditure, or debt ensues. Modern monetary theory argues this entire premise is backwards. Economists like Stephanie Kelton point out that the orthodox consensus operates on a flawed understanding of how modern commercial bank clearing actually works. This chart plots Japan's national deficit alongside its interest rate over a multi-decade period. The country ran massive, sustained government deficits, yet its interest rates remained flat at the absolute zero bound, directly contradicting the crowding out hypothesis. Sovereign deficit spending does not drain private savings, it creates them. If the orthodox model is operationally backward, modern macroeconomic policy is unnecessarily restricting itself based on a misinterpretation of financial mechanics. To understand the error, we have to look at the origins of money itself. The orthodox assumption is rooted in metallism, the idea that money evolved organically from scarce commodities to replace the inefficiencies of barter. Chartalism offers a different history. It argues money did not originate as a highly tradable commodity. Early money functioned purely as a credit and debt relationship recorded by authorities. These medieval tally sticks tracked state obligations and tax liabilities long before standardized precious metals were required to back them. This leads to a core concept of modern monetary theory: taxes drive money. A sovereign state issues an otherwise worthless fiat currency and creates immediate demand for it by imposing tax obligations that can only be paid in that specific currency. This diagram maps the modern financial architecture, establishing what economists Hyman Minsky and Jeffrey Ingham call the hierarchy of money. The base layer consists of the private credit IOUs generated by households and firms during everyday trade. The middle layer is commercial bank money. Banks issue these liabilities to clear the private IOUs generated at the base. The apex layer is state money. Consisting of central bank reserves and treasury IOUs, this is the ultimate clearing authority for the entire system. Because state money sits at the top, the operational sequence only flows one way. The state must issue its apex currency into the economy before the lower layers can possibly obtain it to pay their taxes. Taxation does not fund a sovereign state. Taxation functions to drain liquidity out of the private sector and enforce ongoing demand for the state's currency. We can definitively prove this by carefully tracking the exact accounting mechanics of a massive government deficit spend. This diagram represents the three interconnected balance sheets required to clear national transactions. First, the Treasury, tracking government assets and liabilities. Second, the central bank, or the Fed, which processes the state's payments. And third, the commercial banking sector, which interfaces directly with the public. Here is the scenario. The Treasury issues $1 trillion in checks to fund a nationwide public works program. Private citizens and contractors receive those checks and deposit them into their local bank accounts. For the commercial banks, this creates an immediate $1 trillion increase in their liability column, representing the new private deposits they owe to their customers. To settle the transaction, the central bank credits the commercial bank's reserve accounts. The Fed marks a liability, and the commercial banks gain a matching asset in the form of Fed reserves. Look at the new state of the commercial banking sector. It is now holding a massive influx of non-interest-bearing excess reserves. Banks do not want to sit on zero-yield assets. They immediately attempt to lend these excess reserves to each other in the overnight interbank market, known as the federal funds market. This creates a systemic paradox. Because the deficit spend flooded the entire banking system simultaneously, All banks have excess reserves. None of them need to borrow. This graph shows the federal funds rate. With infinite supply and zero demand in the overnight lending market, the price of borrowing plummets directly to zero. The textbook model insists that deficits crowd out private borrowers by absorbing savings and pushing interest rates up. The accounting proves the exact opposite. Left unchecked, expansionary fiscal policy mechanically drives interest rates to zero. The orthodox assumption is operationally false. This raises a logical question. If deficit spending funds itself by creating deposits and drives interest rates to zero in the process, why does the government issue treasury bonds at all? The answer lies with the central bank. The Fed has a mandate to maintain a positive target interest rate to manage inflation and the economy. It cannot allow the overnight rate to remain at zero. Looking back at the balance sheet dashboard, we can see how the central bank intervenes in the flooded interbank market through open market operations. To mop up the excess reserves, the central bank sells treasury bonds to the commercial banks. The banks gladly swap their zero-yield reserves for an asset that pays a positive yield. Economist Abba Lerner defined this mechanic as functional finance. Government bonds provide an interest-bearing alternative to unwanted reserves. They are issued to drain excess liquidity from the banking system and hit a target rate. Sovereign bonds are a monetary policy tool. They are not a fiscal funding mechanism for the state. Orthodox economists like Krugman counter this doesn't matter, arguing central banks can simply cut interest rates to stimulate the private sector instead of government deficits. But lowering the cost of borrowing fails to induce new private investment if businesses have depressed expectations of future profits. Cheap credit cannot force a factory to expand if there are no customers to buy its products. This table translates the divergence between textbook economics and modern monetary theory. The textbook views taxing and borrowing as vital funding mechanisms. The modern framework exposes them as tools to drain money and control interest rates. This flowchart illustrates the differing constraints at play. Households, firms, and local governments are users of the currency. Their spending is strictly constrained by their income and their borrowing capacity. They face a hard barrier of financial solvency. A currency-issuing sovereign bypasses financial constraints entirely. Its ability to spend is limited strictly by the availability of real resources, the labor, materials, and productive capacity in the economy. Push past that limit, and the result is inflation. Operating a modern economy on orthodox rules of sound finance ignores this distinction. It assumes the state faces the same financial limits as a household. By misunderstanding the endogenous nature of credit and central bank clearing operations, policymakers are artificially crippling the state's ability to mobilize resources and solve real-world crises